Hi, I'm Pattu from FreeFinCal, and let's look at how to book profit from small cap mutual funds and invest in them tactically. So this is a follow-up video to the SBI small cap fund review. I had said that investors who are looking to choose small cap funds should consider a tactical asset allocation tactical asset allocation strategy. And this is one such example of how to book profit from small cap funds. So this is the growth of small cap 250 total returns index and Nifty 50 total returns index. Now, if you look at this growth over the past, this is from 2005, so over the past 14 years or so, notice that if I had put some lump sum money right here in 2005, April 2005 roughly, I would have just got the same amount of money whether I had invested it in Nifty 50 or the Nifty small cap 250. Essentially, what happens with the small cap, I have chosen indices because there will be no selection bias. Now, essentially, what happens with the small cap funds or the small cap stocks is that it zooms up, and then when there's a crash or a fall, it'll just fall all the way down, and then nothing happens for a while, and then it zooms up again, then it falls down, and so that's the problem. So it's a huge roller coaster ride. I mean, even the Nifty itself is a roller coaster ride, and this is like a roller coaster on Red Bull. So it's very difficult to control your emotions when you are doing that. So that's where the tactical asset allocation comes in. You periodically take out money and you re-enter back. Now, what I am going to show you is just one example and one method to do it. We do not have too much of market history. It's just 13-14 years that we are going to look at. So that's just one data point actually in terms of tactical asset allocation. I have done several posts on tactical asset allocation with equity and fixed income, where I have done repeatedly for several durations. But I've considered one duration for this video, because doing it for 3 years, 4 years, 5 years and so on, I'll get more data points, but it doesn't make any practical sense to do that. So this is over 13 years I'm backtesting, but before I do that, I want to issue a warning. So maybe we should do it fast. The following is to be treated as investment, something like that. Okay, so let me do it slow. The following is to be treated as an investment research based on past data, unrepresentative of practical implementation, and is not investment advice. They do not factor in behavioral or emotional aspects associated with investing. If you do not know how to understand a backed result, evaluate its disadvantages, then please do not play with your money using market timing. Only one backtest result has been shown, as I've just mentioned, and the results will vary if you do it for more periods. So please be careful while you are interpreting this result and want to implement this as a strategy. I have used this I've used one test period, and I've said it is not representative of practical implementation because of the kind of asset allocation I've used, but you can use much better asset allocation. I'll explain that in the next slide. So it's only an example. Again, in real life, the tactical swings would be different. So one more slide of warning, just to be sure. So what we're going to do is we're going to take the small cap 250 index, and we're going to plot the 10-month moving average. So we take the monthly data, let's say on the first of every month, you take that as the monthly data, and then you calculate the 10-month average on a rolling basis. It just keeps moving, and that's the 10-month moving average. So it smoothens out the fluctuations you see in the price. And so what we're going to do is to find out when the price, so we're going to check every month at the time we're going to invest, we are ready to invest, we get money and we are ready to invest. If the current price of the small cap is greater than the 10-month moving average, that's like in this region, we do something. Or if the current price of the small cap falls below the 10-month moving average, like in here, we do something else. That's called tactical asset allocation or market timing with trend following techniques. Moving average is one trend following technique. Now I have a link in the description box, and you can understand why the 10-month, or if you read that, you can understand why the 10-month moving average is used. And I've also shown results for fixed income and equity. I also have a category called tactical asset allocation in FreeFinCal. If you click on this description box, right at the top, you will see the category. There's a sub link which will say tactical asset allocation. If you click on that, you will see the entire archive of all the tactical asset allocation backtests I have done. So you can read that and understand how this works. I have made a couple of videos on tactical asset allocation, but not too much. I'm not sure how many of you are interested and so on, but let me see. See, the problem with market timing is everybody wants to time the market, but everybody thinks that they will just time the market by buying on dips and not buying when the market is overheated. I have shown that that is a useless strategy. If you want to get higher returns, or if you want to reduce risk, or if you want to do both, then you must be ready to book profit and re-enter back at opportunistically. So unless you're ready to do that, do not think about market timing. Buying on dips is silly. It's just a childish thing that new investors think about. So what is the procedure for the backtest we have done? So we are going to look at a systematic investment strategy where we take 2,000 rupees every month and put 50% or 1,000 rupees in Nifty 50 and 50% in Nifty small cap 250. So that's the 50-50 strategy. This is the reason why I said it's not really practical, because I'm doing this to show you an example of how to do the profit booking. But in practice, 50% of large caps and 50% of small caps is kind of a slightly risky portfolio. Please recognize this market timing method is only for the equity portion of your portfolio, right? We are not talking about fixed income. That's separate. That's always there. I'm not saying don't invest in fixed income. It's only for the equity portion, and 50% of it is in large caps, 50% in small caps. Most people would have some mid caps, and see, one portfolio is 50% large caps, 25% mid caps, 25% small caps. That's a better portfolio in terms of risk and reward. But this is just for example. That's why I said it's not representative of a practical implementation. But I want to show you the impact of doing this. That's why I took this example. So that's a systematic investing. In tactical investing, what we will do is we'll check the index, that is the small cap index, once a month at the start of the month, let's say. If the current price of the small cap index is greater than its 10-month moving average, then we will put 2,000 rupees, that is the entire money to be invested that month in equity, into the small cap index. Then we will also sell the Nifty, whatever large cap we have, we will sell it and invest it into small cap. So it will be entirely into small cap when the current price is greater than the 10-month moving average. When the current price falls below the 10-month moving average, we will invest the full money for that month into large caps, that is a Nifty 50. We will sell the small cap and completely move into Nifty 50. That's not fixed income. That's a copy paste error. Sorry. So sell the small cap and invest fully into Nifty 50. Excuse me. So this is the swing market timing that we're going to use. So when the current price is greater than 10-month moving average, we will be fully in small caps and invest only in small caps. The current price is less than the 10-month moving average, we will be only in large caps and invest only in large caps. So again, let me show you graphically. So in this case, notice that the price has fallen below the 10-month moving average. Then you will sell the small cap and invest only in Nifty 50. You will be only in Nifty 50. And when the price starts moving above the 10-month moving average, you will sell the Nifty or the large cap and invest the full amount in small cap. This is the tactical asset allocation strategy, back tested. We are comparing this with the systematic strategy of always 50% Nifty 50 and 50% Nifty small cap 250. The systematic investing is rebalanced once a year. That portfolio is rebalanced once a year to reduce risk. And also, because you are rebalancing once a year, your 4% amount is 4% is removed as tax at the final after 13 years. When you look at the 13-year window, finally 4% is deducted before the return is calculated to account for rebalancing the exit loads and taxation and so on. In the tactical asset allocation, because we are going to be doing what can I say, little more of swinging, that is, we are going to swing fully from small cap to fully from large cap. The asset allocation is going to change. The equity asset allocation is going to change a little more. Because of that, a 20% value is removed as due to tax and exit loads and so on. In real life, it may so happen that you may be paying more exit load and more tax for systematic investing because you will be doing more number of rebalancing than in tactical method. It depends, because I'll show you an example in this case itself. but it depends. You have to assume that you lose more money in tactical investing. Even after losing that much money, is the tactical investing able to offer some benefit for the in comparison with the systematic investing is the problem that we are interested in. That's what we are going to study. So that's what I just said. Let's look at the result. So that's the result run over a 13-year period from 1st February 2006 to 1st February 2019. Notice that the tactical asset allocation has moved up. Initially, for the first few years, there's not much of a difference. It's just a little bit above the systematic portfolio. This is the portfolio. So this is the value of the portfolio. We start at 2,000 rupees and now it has gone up. We keep investing on tactically or systematically, and the portfolio value has gone up. You can see that the tactical portfolio has really moved up around the time when Narendra Modi was announced as the prime ministerial candidate just before the 2014 Lok Sabha elections, and then it kind of moved up, and then now it's starting to fall down. It's starting to correct right here. So we'll see how that goes. That has to be tested. So that's the test. Now, when you look at it, clearly the tactical asset allocation has got more returns. Clearly, the tactical asset allocation has got a higher portfolio value. That's obvious from here. But the risk, when you visually look at it, is not lower. The tactical asset allocation strategy, at least for this backtest window, for this single window, so it's only one data point from that point of view. For this window, the risk is not lowered comparatively to the systematic value. At least up to this point, it may be worse from so on. Let's see how that works. So let's look at the actual numbers. So the start date of the portfolio is 1st February 2006. The end date is 1st February 2019. This is the one window. So all this represents one data point. The systematic annualized return is 10.5%. The tactical annualized return is 12.75%. The systematic value after the final value is 6.4 lakhs. The tactical value is 7.6 lakhs. So that's a good 1 lakh and odd more. The maximum drawdown, that means the fall from peak of the portfolio to the bottom. The maximum drawdown, that is, let me just go back here. That is drawdown means that's the peak and it falls here. That's the drawdown. From this peak here, how much it has fallen down. So for the systematic, the maximum drawdown is minus 48.9%, and for the tactical, it's a little more. So there's not much difference in the risk, and the number of times you have to sell off the equity for the tactical asset allocation is only 8. In a 13-year period, you are selling off equity completely only 8 times. That's awesome, I think, for at least for the window considered. And the number of months, number of equity sell-off means number of times you sell off the small caps. That's what it actually means. 8 times you will completely exit from small caps. 8 times. And the number of times, number of months where there will be no investing in small caps will be 79 months. Total number of months where there is no investing in small caps, that's 79 months. And for a maximum period of 14 months, that's a little more than a year, you will not invest in small caps at all. So you should have the discipline to stay away and be in large caps. Otherwise, it will not work. The standard deviations of the fluctuations in the monthly portfolio returns more or less are comparable. So it's not much in terms of risk. This tactical asset allocation strategy does not help you in terms of risk, at least for the window considered, but it certainly has done well in terms of return and the extra corpus value. That's pretty significant. I mean, the 1 lakh is pretty significant because the monthly investment is only 2,000 rupees. So that's like 24,000 rupees a year. So that's pretty significant. So, and again, you have the number of months underwater. That means the portfolio has gone up like that, and then it falls down. And the number of months it stays below the maximum is 64 months in systematic, and tactical is 67. That's again comparable. And the maximum number of continuous months, so the portfolio is up like this and then it falls down and remains underwater continuously for 19 months in systematic, but for tactical it's 22 months. So it's a little more, but again it's comparable. You can't say anything because it's just all this. Please recognize, all this data is for one window. You have to change the window and see what happens. I have done this for the other tactical asset allocation backtests, but for this I cannot because I do not have much of data. So that's the essential result. So what is the summary? I have considered only one 13-year period The return is higher, but the risk is not lowered, at least for this. But please recognize this is not a very practical portfolio, because we are swinging all the way from 100% large cap to 100% small cap and back and forth. So it's not a practical swing in real life. Most people will not may want to swing, may want to do it little moderate than that. More history is necessary to conclude anything as an analyst, but as an investor, it completely makes sense. See, for example, you don't need to look, even if you don't want to look at all these market moving averages or PE or whatever, just look at your small cap returns last 6 months, last 1 year. If the last 6 months return is 45% absolute return, or the 1 year return is 100%, whatever, then it makes absolute sense to remove some money from the small caps and put it into large caps or put it into fixed income. Just common sense. Forget about how much return you will make at the end of the day, how much risk is lowered. It is just simple common sense to remove money in an overheated market. So at least from that point of view, I think people should do some kind of tactical investing with small cap, even without any method. With the method may work better, but even without a method, it makes it's intuitively makes sense. The only problem is when you start claiming I am doing tactical investing, therefore my method is superior to a systematic investment. That is wrong. Don't say that. Please recognize the purpose of tactical investment is to reduce risk. Sometimes risk may not get lowered, sometimes return will get enhanced, sometimes other will happen, whatever will happen. So that is why you need to check multiple periods. That's why I said as an analyst I cannot conclude anything, but as an investor it makes complete sense to remove money out of a heated market. There could be other tactical methods like using double moving averages, you can use Bollinger Bands, you can use PE, but PE I don't know how useful it will be for small caps because we do not have much history and so on. That's another problem. So you can consider all those methods, or you can just do common sense. Look at the last 6 months, last quarter or last year absolute gain, and if that's too much, just remove money out. And if for example small caps are now fallen 20%, so now is a good time to invest more money in small caps, right? You can do that, provided your goal is several decades away. As long as you are, if that's the plan, that's not there's no issue. So this has been one example of a backtest window. Please let me know if you have any questions. I'll catch you in another video. Bye.